For the first time in history, the ultimate safe haven asset has crossed a line that once seemed unthinkable.
Gold and silver jumping to all-time highs.
This month, the yellow metal has been on a stunning rally. It looked like gold was unstoppable.
Last week, gold surged past $4,500 per ounce. It delivered nearly a 70% return in a single year. This is not just another commodity rally or a seasonal spike. This is a signal, one rising from the deepest layers of global finance. But here's the $5,000 question. Was this the peak, or just the beginning of something we haven't witnessed in years? In today's video, we're going to do three things. First, we'll break down why gold exploded in 2025. Second, we'll uncover what central banks are quietly doing behind the scenes. And finally, yes, we'll project where gold could be heading in 2026 and beyond. Because this wasn't just a commodity rally, this was a warning signal. And if you're an investor or a trader, you can't afford to ignore it. Gold has a habit of speaking softly until the system is under stress. In 2008, as banks collapsed, gold crossed $1,000. In 2011, amid sovereign debt fears, it surged to record highs. In 2020, when the world shut down, gold crossed $2,000 during the pandemic panic. Every time confidence in the system cracked, gold didn't ask questions, it responded. Not because gold produces cash flow, but because gold produces trust when everything else doesn't. And in 2025, that trust was suddenly in very high demand. So what changed? Here are the 6 forces that turned a whisper into a roar. 1. Central banks, the silent buyers. This is the most powerful force driving gold's rise. For years, central banks have been quietly buying gold at an unprecedented pace. The turning point came in 2022 when G7 nations froze Russia's dollar-denominated reserves after the invasion of Ukraine. That moment sent shockwaves through the global financial system. For many countries, the message was clear. Dollar reserves are no longer politically neutral. Since then, major economies, especially China, have accelerated their shift away from the dollar. Central banks have flipped their behavior entirely. In the early 2000s, they were net sellers of gold. Today, they are buying nearly 1,000 tons per year. This is not speculation, this is strategy. Gold offers sovereignty. Gold cannot be sanctioned. This trend, according to analysts, still has room to run. 2. The dollar's shadow and the debasement trade. The foundation of gold's historic surge in 2025 was laid by one key development: a sharp loss of confidence in the US dollar. In 2025, the dollar suffered its largest 6-month decline in over 50 years. This sparked what investors now call the debasement trade. The debasement trade is simple but devastating. If trust in fiat currencies weakens, investors seek assets that cannot be printed, frozen, or devalued. Gold has no counterparty risk. It does not depend on policy decisions or political stability. Adding fuel to this shift was growing uncertainty around the Federal Reserve. During President Trump's second term, pressure on the Fed to cut interest rates intensified. Lower rates weakened the dollar. They also reduced the appeal of yield-based assets like treasuries. Gold, which yields nothing, suddenly becomes more competitive. In an environment of falling rates and rising uncertainty, gold thrives. Gold thrives in uncertainty, and 2025 delivered it in bulk. The global economy entered a strange paradox. Growth was slowing, inflation pressures remained sticky, supply chains were fragile, debt levels were unimaginable. For investors, this created a heads I lose, tails I lose scenario. If central banks cut rates to save growth, currencies weaken. If inflation stays high, purchasing power erodes. Either way, gold wins. Gold doesn't hedge inflation directly, it hedges policy mistakes. And in 2025, the market started pricing in more of those than ever before. 4. Geopolitics, the insurance trade. The world today is fundamentally unstable. Geopolitical tensions remain elevated. Trade relationships are fragile. Supply chains are vulnerable. Markets don't need catastrophe. They price probability. Gold becomes valuable not because disaster is certain, but because uncertainty is persistent. In 2025, gold wasn't bought out of fear, it was bought out of prudence. The ultimate insurance asset doesn't wait for confirmation. 5. The retail wave, ETFs and investor demand. This rally is not driven by institutions alone. Retail investors are returning to gold in force, largely through gold-backed ETFs. In September 2025, ETF inflows hit their highest level in over 3 years. JP Morgan expects this trend to continue, forecasting around 250 tons of ETF inflows in 2026. As interest rates fall, holding gold becomes more attractive relative to cash and money market funds. Demand is broad, and it is growing. 6. Gold as a hedge against the AI bubble. Gold's surge is also a reflection of fear inside equity markets. Stocks are expensive, market leadership is narrow. A handful of mega-cap tech stocks dominate indices. Sound familiar? Late 1990s. .com era. The AI revolution may be real, but bubbles often form around real innovation. Gold serves as insurance. If equities fall, gold historically performs well. Holding gold is not about pessimism. It is about balance. Central banks are the backbone of this rally. Today, global central bank gold holdings stand at approximately 36,200 tons, nearly 20% of total official reserves, up from around 15% at the end of 2023. The United States, Germany, France, and Italy together control nearly half of the global official gold reserves. The US alone holds 80% of its reserves in gold. But the real signal lies in what emerging markets are doing. China, despite holding the world's largest total reserves, has only 7.68% allocated to gold. India holds around 15.17%. This imbalance suggests significant room for future accumulation. For 2026, JP Morgan expects central banks to purchase around 755 tons of gold. That number is lower than recent years, but not because demand is weakening. Gold prices are simply higher. Central banks need fewer tons to achieve the same reserve diversification. The appetite remains structurally strong. So where does gold go from here? The evidence points in one direction. The forces driving gold higher are not exhausted. Goldman Sachs expects gold to rise to $4,900 an ounce by the end of next year. The most common target among global banks, including HSBC and JP Morgan, is $5,000 an ounce by the end of 2026. Investor and central bank demand combined is expected to average 585 tons per quarter. The long-term outlook is even more aggressive. Analysts see potential for $5,400 per ounce by the end of 2027. And what about $6,000? JP Morgan outlines a scenario where a mere 0.5% diversification of foreign US assets into gold could push prices to that level. With gold supply slow to respond, upside risks dominate. Yes, volatility remains. A major geopolitical de-escalation could cause pullbacks, but the secular trend is clear. Gold's 2025 rally wasn't about greed, it was about trust erosion. It was about a world quietly admitting that the old anchors, currencies, bonds, political stability don't feel as solid anymore. Gold doesn't promise growth, it promises survival. And in a fragile system, survival becomes priceless. Whether gold hits $5,000, $6,000, or pauses along the way, the message is already clear. The system is changing, and gold is once again standing at the center of it. The golden warning has been issued. The only question left is, are you listening? If this video made you rethink gold, if it made you question the system beneath your feet, comment below. Is gold headed to $5,000, $6,000 or higher? Like this video to keep the signal alive. Share it with someone who still trusts the old anchors. And subscribe, because when the next warning whispers, you'll want to hear it here first. The signal is clear. The clock is ticking.